Governments love to say they're working for your financial freedom. They talk about stability, growth, opportunity, and prosperity for everyone. It all sounds reassuring. But if you take a step back and really look at history, a much darker pattern starts to appear. Time and again, governments have relied on hidden financial tricks to keep ordinary people struggling, while quietly concentrating wealth and power at the top. And here's the unsettling part. None of these tricks are new. They've been recycled for centuries, repackaged with new language, renamed to sound modern and responsible, but always serving the same goal: moving wealth upward and keeping the majority dependent. Let's start with the oldest and simplest trick of all: inflation. When a government spends more than it can collect through taxes, it faces a choice. It can be honest and raise taxes openly, which is politically risky and often unpopular. Or it can quietly reduce the value of its currency, making every coin and banknote worth a little less. Ancient Rome mastered this approach. In the 3rd century after Christ, emperors struggling to fund massive armies began reducing the silver content of the denarius. What was once nearly pure silver slowly turned into mostly copper, coated with a thin layer of silver to maintain the illusion. Officially, nothing had changed. In reality, everyone holding those coins paid the price. Inflation surged, savings lost value, and wages failed to keep up. It was a silent tax on the population, one still used today, only now it's managed by central banks instead of imperial mints. The Middle Ages brought a different version of the same game: forced loans. Kings and monarchs in England, France, and Spain regularly pressured wealthy merchants and guilds to lend money to the crown. These loans were requested, but refusal often meant fines, confiscation, or worse. Sometimes repayment was promised with interest, but it usually came late, in devalued currency, or not at all. Wars were fought, palaces were built, and the crown carried on, while merchants had no real choice but to surrender their capital. The trick was coercion, dressed up as duty or patriotism, and it worked for generations. By the 17th century, the financial system itself became the trick. When Britain created the Bank of England in 1694, it wasn't an act of public service. The government needed money to fund wars against France. Wealthy investors bought government bonds, and in return, the crown guaranteed interest payments, funded by taxes. On the surface, it looked fair. But who paid those taxes? Ordinary people, through duties on everyday goods like salt, beer, and cloth. The wealthy lent money and earned secure returns. The poor paid higher prices to fund those returns. It was a wealth transfer system disguised as national finance, and it set a pattern that still exists today. Lending money to governments remains one of the safest investments in the world, because the returns are backed by the labor and consumption of the masses. Fast forward to the modern era, and these tricks are everywhere. Take deficit spending. Governments pile up enormous debts, issuing bonds bought by banks, investors, and foreign governments. Politicians tell the public the money is for roads, jobs, education, or social programs. Some of it is. But huge portions flow into defense contracts, corporate subsidies, and financial bailouts. When the bill comes due, spending at the top rarely shrinks. Instead, taxes rise, currencies are inflated, or social benefits are cut. The debt is sold as being for the people, but the burden lands on them while profits flow to bondholders. Then there are bailouts. During the 2008 financial crisis, banks made reckless bets, packaged toxic mortgages, and nearly collapsed the global economy. When it all fell apart, who paid the price? Ordinary taxpayers through massive government rescue programs, and who benefited afterward? The same banks, which emerged larger, more powerful, and more concentrated than before. The trick was simple: privatize the gains, socialize the losses, and tell the public it was necessary to save the system. Even pensions and retirement systems involve a quiet sleight of hand. In countries like the United States, Britain, and across Europe, people pay into government-managed retirement programs trusting that the money will be there when they need it. But in many cases, that money isn't saved. It's spent immediately, replaced with promises and IOUs. Future taxpayers are expected to cover the cost. It functions like a generational Ponzi scheme wrapped in official language. It works until populations age and demographics shift. Then the system becomes unsustainable, and reforms arrive in the form of lower benefits, higher retirement ages, or payouts quietly eaten away by inflation. There's a clear pattern here. At every stage, perception is the key. Inflation is called growth. Forced loans become duty. National debt is framed as investment. Bailouts are sold as stability. Pension cuts are labeled reform. Language hides reality. And that reality is a steady transfer of wealth from the many to the few, from the bottom to the top. This has worked for centuries because most people never study economic history, never learn how financial systems actually function, and only realize what's happening when it's already too late. In recent decades, the tricks have grown even more sophisticated. Consider quantitative easing, a term few people heard before 2008. Central banks created trillions of dollars out of nothing, buying bonds and mortgage-backed securities to stabilize markets. Officials insisted it was necessary to prevent collapse. And for the financial system, it worked. Asset prices soared. Stocks, real estate, and bonds surged. But who owns most of those assets? The wealthy. For average households without significant investments, the benefits were limited, while the costs appeared as higher living expenses and distorted markets. The trick was that money creation rescued the top while deepening inequality for everyone else. Another modern tactic is stealth taxation. Instead of openly raising income taxes, governments rely on sales taxes, fuel duties, and especially inflation. When prices rise faster than wages, purchasing power quietly disappears. Governments benefit because inflation reduces the real value of their debts. Citizens lose because their savings and earnings buy less. You might feel richer because your salary number is higher, but if costs rise faster, you're actually poorer. This isn't an accident, it's how the system functions. Then there's regulatory capture. Regulations are supposed to protect the public. Financial rules, safety standards, consumer protections. But history shows that powerful industries often shape the very rules meant to restrain them. Railroads in the 19th century, oil in the 20th, and tech and finance today all influenced regulators in their favor. The logic is simple. It's easier to own the referee than to play fair. The public sees protection, insiders see profit. War finance follows the same script. During the World Wars, citizens were encouraged to buy bonds as an act of patriotism, and they did support their nations. But these bonds also became safe, profitable investments for the wealthy, guaranteed by future taxes. In the modern era, wars in Iraq and Afghanistan were funded by debt that enriched defense contractors and bondholders, while ordinary taxpayers carried the long-term cost. Wars are always sold as temporary emergencies. The financial consequences last for generations. Finally, governments weaponize complexity itself. Tax codes thousands of pages long. Financial instruments so intricate, even experts struggle to explain them. Budgets filled with jargon and hidden details. Complexity becomes camouflage. If people can't see where the money goes, they can't resist the transfer. In ancient Rome, debased coins made the trick visible. Today, it's buried in spreadsheets and acronyms. Why does this matter now? Because these tricks aren't fading, they're accelerating. Inflation eats savings, debt expands, bailouts remain the default response to crises. Central banks continue to manipulate money. Costs are passed on to the public so indirectly that most people never connect the dots. The result is a system that demands more work for less real wealth, while financial elites grow ever stronger. History's lesson is simple but uncomfortable. These tricks always come back. Different eras, same mechanisms, and most people never escape them because they don't realize they're being played. They accept inflation as natural, taxes as inevitable, bailouts as necessary. They trust official explanations instead of studying the past. And that ignorance is the most powerful trick of all. Financial education is resistance. Economic history is a weapon. When you understand the patterns, you're harder to manipulate, so look beyond the headlines. Ask who benefits first. Remember that inflation is policy, not fate. Question who writes the rules. Build real wealth outside fragile systems, and never assume a system works for you just because it says it does. The tricks that drained Roman citizens are the same ones draining accounts today, just dressed in modern language. The only real difference is whether you recognize them in time. If this gave you a new perspective, hit subscribe. History has the answers.